Good afternoon, everybody. Thank you for joining us today. Today's webinar is brought to you by Florida Makes through a partnership with GrowFL. Today's very timely topic is interpreting the CARES Act for manufacturers and modeling liquidity for financial clarity. And our presenters today are from Clifton Larson Allen. The past few weeks have brought to light the opportunity and importance of online on-demand training, so you can watch out for other industry-related webinars that will be over the next few months, which will all be published on the Florida Makes website. A few housekeeping things before we begin. As a participant, your audio will be on listen-only mode. Throughout the webinar, you will have the opportunity to ask your questions using the question window panel on the side of your screen, and we will address those as time allows at the end of the presentation. This is a live webinar event, which will be recorded, and the link to the recording will be provided to you within a few days and will also be posted on the Florida Makes YouTube channel. So again, thank you for spending your afternoon with us. My name is Hannah Mativia, and I am the Programming and Communications Manager at GrowFL, and I welcome you to today's webinar. So just a little background before we begin. Florida Makes is the Florida member of the MEP National Network. MEP is a manufacturing extension partnership, which is a program in the U.S. Department of Commerce and the National Institute of Standards and Technology, which you might also know as NIST. It is their mission to assist small and medium-sized manufacturers by providing resources that will help them grow and prosper. So if you would like to know more about Florida Makes, you can check out their website at www.floridamakes.com. If you're not familiar with GrowFL, our mission is to provide second stage companies in the state with the resources and strategies that they need for next level growth. And through our great partnership with Florida Makes, this gives us an opportunity to engage with manufacturers throughout the state as well. So typically our programs are centered around peer-to-peer learning, leadership development, and also our System for Integrated Growth program. However, in the last few weeks, we have shifted gears a bit and created new programs specifically centered around helping business owners navigate COVID-19. So to do so, we launched our Expert Connect. This is a feature on our website where any business owner can sign up for a free 30-minute phone call with one of our trusted experts. So they just visit our website, let us know the area of concern or specific questions that they have. And once that's submitted, we immediately get to work matching them up with an expert in our database who's best equipped to walk them through their problems or answer their questions. So it's been very successful so far, and we're excited about business owners across the state utilizing it. So this and other resources and upcoming events can be found on our COVID-19 business resource page, which is linked there. So that's a quick overview. I encourage you to visit our website, check out our business resource page and our other various programs. That's our contact link on our website, but also my personal email. So if there's anything I can assist any of you with now or in the future, please feel free to reach out. So with that, I will introduce our first presenter from Clifton Larson Allen, who is also another valued GrowFL corporate partner. First, Marnie Spence is a principal in CLA's Manufacturing and Distribution Industry Group and leader of the manufacturing industry for the Orlando office. She has more than 29 years of experience in public accounting, specializing in tax services for multi-state C corporation, S corporations, and partnerships. She also has significant experience with research and development tax credit and works with many government contractors in the modeling and simulation industry. So with that, Marnie, I will turn it over to you.
Thank you so much, Hannah, and we are just really excited to be a part of the presentation through GrowFL and Florida Makes, is that we're one of your experts to help if any business is calling in that to answer some of those questions. I really want to thank my team members, Leslie and Matt, being a part of this presentation. CLA, we're a national firm that works with owners of privately held businesses. Where focus often is in industry-based. Leslie and I sit in the industry for manufacturing and distribution. I am in the Orlando office. Leslie's from our Indianapolis office. Matt, who is our expert on our modeling piece of it, is actually in our Minneapolis office. So we're just all learning how to work virtually and how to homeschool our kids at the same time, just as everybody else is. And so we're in this together. But we really understand the essentialness for manufacturers is that, you know, manufacturers are just trying to keep your doors open and worried about your employees and your families, and really understanding then on top of that is customer needs, your supply chain, your vendor. Many of our manufacturers are working together on how to make protective gear in this uncertain times too for their communities. And so, you know, we are networking with over 5,000 manufacturers nationally, and we just want, you know, all manufacturers to know, all business owners to know that, you know, we're here for you in any way to help along with that. So I really want to thank you for this opportunity, but also just thank our manufacturers here in the United States to make our companies, our country strong. So Hannah, with that next slide, we'll get started. Our agenda today has us going over the CARES Act that's been enacted for about a week now. And then also we're just going to cover some filing and payment deadlines there, and then turn into this evaluation for some financial implications for that. The next slide, please. The CARES Act is an acronym for Coronavirus Relief and Economic Security Act. What it really does, its true thought behind it is to protect the working families, right? To generate liquidity. And so it sets up tax provisions, but also lending provisions, but they're very interwoven with one another. So what we're going to do is try to help you understand this for the strategies on how to work through those. Next slide. So the first part of this CARES Act then is the recovery rebates for individuals, how everybody's wondering when these checks are coming in the mail. And what you have here is $1,200 per eligible individual and $500 per qualifying child. You do have a limitation based on your adjusted gross income, and those are stated there for married filing joint, head of household, and then all others as well. Next slide. So I'll walk you through an example of this, is that these are going to be advance refunds based on your either 2018 adjusted gross income, or if your tax return is completed for 2019, it'll be adjusted on that. These refunds were supposed to start on April 6th. We haven't heard of any refund receipts yet, and we've heard that they will probably be delayed. There is a chat function within this webcam today. So if anybody has received their rebate checks, if somebody could just chat in on that and let us know you have. We haven't heard that. So let's go to the Spence family, because what the Spence family has is that there was the question that our daughters that are in college, even though they're preparing their own 1040s, because maybe they had a side job, will they get a refund check? That's not, no, they won't, because they were dependents. And then also, my parents is that are, you know, they're just on Social Security. They're not having to file tax returns anymore. You know, did they, that was that thought, did they have to file a return to get this rebate check? And so now what we have is that the IRS is working with Social Security to find who those Social Security recipients are, to gather that information, and that those checks should be direct deposited. So if we go through an example of this family of 5, and remembering this limitation then on adjusted gross income, through this example, their rebate check then in total could be $3,900. But in this, because of a limitation, this advance refund would be limited to the $1,400. And then if your adjusted gross income is reduced in 2020, then on the credit of that return, you would receive more of that advanced rebate actually when you prepare your 2020 tax return. Now let's say that on that example it flipped the other way and that your adjusted gross income is higher on 2020, and do you then need to repay this advance refund? And the answer of that is no, that once that money's in your bank account, you don't have to repay that. So it's kind of a nice thing there. Next slide, please. So there's some rules on retirement funds too, is that you're actually able to take a penalty-free corona-related distribution up to $100,000. That income would be recognized over 3 years, and you'd also have 3 years to actually repay that. This loan had been increased up to the $100,000 as well. Next slide. Required minimum distributions. Those requirements were waived for 2020, and also, but the option out there to take your required minimum distribution and to contribute it directly to a charity, that option is still in place for 2020. So there's a strategy out there for required minimum distributions. Next slide. There's been a benefit for charitable contributions. So what we would say in tax language, above the line, meaning that before you itemize, you're able to take an actual $300 charitable contribution. And this is, with the new tax reform, your standard deductions have been quite high. And so a lot of people were not itemizing anymore. And so therefore, any of their charitable contributions were never a tax deduction. Now you can get a $300 tax deduction there. Contributions, if you do have standard deductions, your contributions now have increased to 100% of your adjusted gross income, and corporations that you can take a charitable contribution up to 25% of your taxable income as well. Next slide. Student loans. So these student loans here the interest has been waived on this. Please know though that I included this because there's a lot of individuals with student loans out there that are with private pay. These student loans are just with government only programs. So make sure that you're not just assuming this when potentially what you have is your student loans are associated with a private institution instead of a government institution. So, Leslie?
Yeah, thank you, Marnie. So
Absolutely.
Marnie talked about a lot of different opportunities for the working families to get some tax relief that translates to liquidity. And the same is true with many of the business provisions that we see in the CARES Act. So the first opportunity that we have is related to corporate minimum tax credits. And this really relates to the 2018 tax year after tax reform happened, when we no longer had corporate, so C corporation, alternative minimum tax. Under the way that tax reform was written, if we had any alternative minimum tax credit carry forwards, those amounts were 50% refundable in 2018. But again, recognizing the opportunity to get liquidity into the hands of businesses sooner, what the CARES Act has provided for is the opportunity to either have any remaining minimum tax credits refunded fully on the 2019 tax return, or if people feel like there's an opportunity to amend and get that back more quickly on their 2018 tax return, they can do that also. So that might be a situation where you extend 2019 and you're not planning to file until, let's say, October 15th. Then you may consider amending 2018 to get that cash back sooner. Next slide. There's also an opportunity for certain taxpayers to consider delaying employer payroll taxes. Now, when we talk about this, I want to be super careful because we've heard a lot of hype in the media that this is a payroll tax holiday. It's not a forgiveness of the employer payroll taxes, but rather a deferral. So it's effectively an interest-free loan where these payroll taxes will be paid back over a 2-year period, 50% of them as of 12/31/2021, and the other 50% then subsequently due 12/31/2022. There's also the opportunity for self-employed individuals to defer 50% of that amount because it represents what is the employer portion on their tax return as well, just like a business would do. What I do want to point out here is with many provisions of the CARES Act, and this is one of those provisions, if you are taking advantage of the PPP program, then you can't also take advantage of this. So we really have to understand the interplay of all the provisions in the CARES Act and make the best decision possible for your business. Next slide.
One thing I just did want to add on there, Leslie, is that it's really important that if you do suspend those taxes, it's super important that that money set aside, that when they are due, that they are timely paid.
Absolutely. In fact, I would say payroll taxes are one of the worst things to be late on. There can be significant federal fines associated with that. So we always caution people to know your liquidity and know your cash flow. Okay, the next area is related to excess business loss. This was another piece of tax reform that I would say was super unpopular with the Tax Cuts and Jobs Act and has been temporarily suspended. So what this relates to is if you have an S corporation or a partnership and you generate a substantial loss from that S corp or partnership in a given year, the amount of that loss that you can deduct on your personal return is limited. And it's generally limited to $250,000 of what's considered excess business loss if you're single, or $500,000 if you're married filing jointly, which means you can offset up to $500,000 against other sources of income, and the rest gets disallowed until the subsequent year. When you're looking at what constitutes excess business loss, generally, if I'm an S corporation owner and I get a W-2 of $100,000, let's say, and then I have a loss that flows through for $800,000, when I determine what my total business loss is, I would net those two. So I've got now an overall loss of $700,000. And if I'm married filing joint, I could deduct basically a total of $500,000 of that net loss. The remaining $200,000 would carry forward. They have temporarily suspended that requirement to suspend excess business losses in 2018, 2019, and 2020, which gives the opportunity to create net operating losses. And we're going to get into the fact that there's an opportunity to then carry those back. So we've got some possible amendments that we can do in 2018 or 2019 if we were subject to those, and then certainly in 2020. Another thing to note is that when this was created with the Tax Cuts and Jobs Act, there was a lot of uncertainty as to how you defined business income for purposes of the excess business loss rules. Again, in the first example I provided, I talked about netting our wages from the S Corp with the loss that was flowing through on the K-1. They have fixed that in the CARES Act and said that starting in 2021, after this relief period, wages will not be included in that. So again, if we go back to my first example, if I had a loss flow through on my K-1 of $800,000, I'm going to disregard what my W-2 income is and say I can only deduct $500,000 of that $800,000 in the current year, and the rest of it has to carry forward. So just another nuance to be aware of when we get into future tax years. Next slide. Bonus for qualified improvement property is another way to generate tax deductions on a current or a prior year return. This was another area that was not done correctly when the Tax Cuts and Jobs Act was written. So the goal with the Tax Cuts and Jobs Act was to allow qualified improvement property, and I can define that, to be eligible for bonus depreciation. That is really any improvement that you're making to the interior portion of your building that's not structural, or it's not an enlargement of that building or an escalator or elevator. So think about if you own your building, certain types of tenant improvements perhaps that you're making inside that building. They have subsequently corrected that in the CARES Act and said that that now is 15-year property, and that property is also eligible for bonus depreciation. And that's great because generally these items are fairly big expenditures. So we now have the ability to expense those all in the year they were placed in service. And this goes back to the 2018 tax year. So we now have the ability to either amend our 2018 return, possibly generate a loss that we can carry back, or to do an accounting method change on our 2019 or our 2020 return if we've already filed 2019, and claim a catch-up deduction for any amounts starting in 2018. So it's another opportunity to get some immediate asset expensing and to create cash flow and liquidity via tax deductions. Next slide. Similar to some of the unpopular provisions that had come out in the Tax Cuts and Jobs Act, a significant change that came out in the Tax Cuts and Jobs Act was the ability to no longer carry back net operating losses. So 2017 and prior, we had a 2-year carryback of individual and corporate net operating losses. Well, that got suspended with the Tax Cuts and Jobs Act. The CARES Act has said we know there are going to be a lot of people that generate losses in 2020. And we've also instated a lot of provisions to potentially help people create a loss in 18 or 19. Rather than having people have to carry those forward until they've got income, they amended the net operating loss rules and said, we'll give you a 5-year carryback on those NOLs generated in 18, 19, or 20. Now, this is great because not only do we get to maximize liquidity sooner, but also those earlier tax years generally have a higher tax rate than what we do under the current law. So not only can we carry back and potentially get cash and refunds sooner, but now we also have an opportunity for a permanent tax savings by carrying that loss back to a year with a higher tax rate. Next slide. The Tax Cuts and Jobs Act had a lot of limitations to deductions, and one that was also not super popular was an interest expense limitation, which effectively has reduced the amount of interest expense that's deductible based on 30% of our adjusted taxable income, which generally, if you go through the formula, equates to EBITDA. That limit has been increased from the normal 30% to 50% of adjusted taxable income, and this is beginning in 2019. So a lot of the provisions I just discussed started back to 2018, but this one begins in 2019 and then also will be true for 2020. So we may have the ability to amend certain returns in 2019 if we've already filed. I do want to point out in particular, not a lot of our manufacturers have partnerships, but we do have a few that do. Because partnerships have complex rules relating to amendments, what the partnership rules have said is if you already filed and you subjected your interest deduction to 30% of adjusted taxable income on 2019, you will adjust it to a 50% limit, but you're going to do so on the 2020 partnership return. So it's creating a little bit of administrative ease. The other interesting thing when we look at adjusted taxable income being raised to 50% is that they knew that a ton of people were going to have very low EBITDA in 2020. That's the reality of the situation we're in. So when we measure that limitation on 50% of adjusted taxable income on our 2020 returns, we're actually going to look back to what our adjusted taxable income was in 2019, which should create a much bigger limitation for us than if we did that calculation with our 2020 earnings. So there's a few available options that we have when we're looking at our interest expense limitations. Next slide. The employee retention credit is basically a credit that's incentivizing employers to keep personnel on their payroll. I will tell you though, this credit comes with quite a few stipulations, and it's another section of the CARES Act where we really have to evaluate holistically which provisions of the CARES Act we're taking advantage of, because this is another area where if we are going to pursue the PPP lending, which we'll get into here in a little bit, then we can't also take advantage of this tax credit. So this tax credit at the 10,000-foot view is going to be 50% of the wages that are paid to an employee up to a maximum of $10,000 per employee. So it effectively at a maximum level would translate to $5,000 per employee. However, in order to take advantage of these credits, we have to meet one of two tests as an organization. The first test is, were our operations fully or partially suspended due to COVID-19? And the other test is that our gross receipts declined by more than 50% when we compare it to the same quarter in the prior year. And if that's true, we can continue to take the credit until our gross receipts get back up to 80% of where they were in the prior quarter of the previous year. So those are the two stipulations that we first and foremost have to meet. Now, if we meet one of those two tests, then we get to take the credit on employees, but that credit is going to differ based on whether we've got more or less than 100 employees. So if we've got over 100 employees, we are only going to take compensation for any employees that we paid while they were unable to work. However, if we're a smaller business, they wanted to be more beneficial. So they also said, okay, well, in that case, we're going to let you take that on any compensation that you paid so long as you either had a partial suspension or you had a 50% decline in gross receipts. So with that, let's look at an example on the next slide. All right, so here is our manufacturer. They have shut down the factory floor from March 20th to April 14th. They have some personnel that can still work, but they're going to continue to pay all of their employees for that time period. Now, from April 1st through April 14th, what we're going to assume is that we're taking advantage of the paid sick leave that's provided under the CARES Act. So now we've got to look at how do we deal with the 20th of March through the 31st of March. Well, if we're over 100 employees, then we can take the compensation that was paid during that period, but only for employees that aren't working. However, if we're under 100 employees, then we can take all of that compensation paid regardless of whether those employees were working. So we just wanted to point out that subtle difference based on size of the company. But again, if you are somebody who's taking advantage of the PPP lending, then this isn't going to be available to you. Next slide.
So everybody's aware that the filing deadlines have been extended, but let's just go over them very quickly. Next slide, please. So our 1040s have been anything that was due on April 15th. So that included then our 1040s have been delayed until July 15th. That not only then was your filing, but also your payments. One thing not covered in here, though, is that because when these laws are written quickly, is that there were estimated tax payments that were due. Your estimated tax payments are due April 15th, June 15th, September 15th, and also January. So the April 15th estimated tax payment was extended, but the June 15th was not extended, and it was going to get corrected in the CARES Act, and that never happened. So you do have this June estimated tax payment that is actually due before your actual 2019 1040. Gift tax returns were also extended, but estate tax returns were not. Next slide. You do not need to come April 15th. An extension isn't necessary. It's automatically extended until July 15th. One thing that I did want to bring up here, though, is that we're really watching the conformity on states, and that really applies to manufacturers, because you have a lot of manufacturers that are selling tangible goods across state lines. And so a lot of times nexus can fall into play that manufacturers are subject to state taxation when they have employees. It can be just economic nexus within these states, is that if you sell enough in income or volume to these different states, that attaches you to for nexus. But also if you have employees that are following your tangible goods into those states for maintenance or installation or training, is that you have nexus for state tax liability. So we're really watching our clients, and for our clients, the conformity that states are they conforming that they're extending? Some are not. Some are extending on different dates and things like that, and that is just being populated right now as to updates, which states have extended that and which states haven't. So be mindful of that. Next slide. Also included in that were the deferral for retirement plan contributions up until July 15th as well. So it's not just your filings, but it's also your contributions for your IRAs, your Roths, or any type of retirement plan contributions as noted here. I do think the next, so then Leslie, you have lending programs as well.
Yes,
next slide, please.
So we're going to go through at a 10,000-foot view of few of the lending programs here on the next slide. The first one that you've probably heard the most about, and I've been referring to it as the PPP because it's a mouthful, is the Paycheck Protection Program. So this is a loan that can be converted to a grant if you meet qualifying criteria. In order to be eligible for the loan, generally a company has to have 500 or less employees, although manufacturers may be able to actually exceed that threshold based on the SBA sizing charts. So we have some industry segments of manufacturing that can actually go up to 12,000 or 1,250 employees rather. And so it's really important as you're determining eligibility for this, whether or not you qualify considering all of the criteria. The other caveat to this is when you're looking at the 500 employee threshold, you do have to aggregate commonly owned and commonly controlled companies. So that's just another potential pitfall. But a lot of the people on this webinar, I believe, will probably meet that employee threshold. So the maximum amount of the loan that's available is going to be based on a trailing 12 months of payroll, and you look at the average monthly payroll for a 2.5-month period. And then assuming you make qualifying spend for 8 weeks, beginning on the day that that loan is funded, that loan can be forgiven. And the qualifying spend is your employee payroll, rent, interest on mortgages, and utilities. So this can be a fantastic source of liquidity that's also allowing you to keep employees on staff such that when this all starts to turn around, the company can get productive and get up and running much more quickly. We have had a ton of discussions because this has been up and running since April 3rd on this particular loan program due to its popularity. And so far to date, about 70 billion in loans have been funded. The original cap was 350 billion, although there's already huge support in Congress to extend this lending program further, so more to come on that. And a lot of the discussion so far has been on how to apply for these loans and how to size the loans in terms of what qualifies as payroll costs to maximize the loan. In the next week or so, we anticipate as people start to actually get disbursements, then a lot of the focus is going to be on modeling what that spend is going to be over the 8-week period such that you can maximize forgiveness. And that's something that will tie hand in hand to what Matt talks about here shortly. Just real quick too, to touch on a couple other loans that are out there. The SBA also has emergency industry disaster loans. These are EIDL loans. You can get those in addition to the PPP loan that you take out. These can be used to fund working capital amounts. So think about accounts payable, for example. And you can get these loans up to a maximum of $2 million. The neat thing about applying for these is that even if you don't end up getting approved for the loan, you get an automatic $10,000 grant within 4 days of making the application. That's this CARES Act emergency grant that we reference. And so we're really encouraging people to explore these EIDL loans, if nothing else, to get that $10,000 emergency grant. The EIDL loans are required to be repaid, but it's at a fairly low interest rate of 3.75%. And so it's still another really good source of liquidity in a time where companies are working for that. Down the road, we will see more guidance on mid-sized lending programs. That's just now starting to get released. So stay tuned, stay engaged. There's going to be a lot more to come on that. So with that, I believe we're going to pass things off now to Matt, who's going to talk about cash flow and managing liquidity.
Can I just add real quickly is that
absolutely.
Yeah, so I just had today, a client of mine was funded last night with her PPP loan. And I think, Leslie, you said you've had a handful of your clients be funded as well, correct?
Yes.
Yeah. So maybe we could add in the chat room as well, is that if others, we're just trying to get a feel for, how this funding is who's getting in and who isn't and things like that. We're kind of watching that at a national level right now too. So sorry to interrupt. We do have within this decision tree right here, it's also a part of the handouts within your go-to meeting that you will see that this decision tree, which really kind of very somewhat easily walks you through decisions as to these different lending programs that so if you have any questions on it, but it's also a part of a virtual handout that we have as well. So, all right, Matt.
Yeah, thanks, Marnie. Yeah, that flow chart really helped basically concentrate, like make it a little bit more concrete for me how this actually kind of flows through. I'm a very visual person, so this was great for my learning process. So maybe if we jump ahead a couple slides, if that works. So we're talking about financial analysis, and a lot of people are probably wondering, what are they doing having the 7 stages of grief here? Why are we talking about this? And the one thing that, with this process, it sounds odd, but going through the 7 stages of grief and talking through it with our clients has been almost the most valuable part, because these are just unprecedented times. there's so many people out there that with so many unknowns, and plus this was something that no one saw coming, especially to the extent that we saw coming, that people, once they could start orienting around like, where am I in these 7 stages of grief, and realize that we are in the anger and bargaining, or we're still in the pain and guilt, or the shock and denial. It really, it's hard to make good decisions when you're sitting in that realm. So that's why with the 7 stages of grief is we're really trying to help you just realize, where are we in this process, and how can we get to a better place so we can make better decisions. So if we go to the next slide. So a couple of key lessons that we've learned with just going through this process. One is that basically the next 90 days are the most important. So yeah, we can think what's going to happen this summer, we can think what's going to happen this fall, but if you're looking at your own organization, you probably would agree that getting through the next 90 days is going to be a hurdle, and some of the PPP loans and such can really help out. And then there was another thing that is this COVID curve process that I want to teach everybody about today and kind of orient everybody about today, because this is a way that you can really basically apply this to your own organizations and maybe get a little bit more structure to how you think about this. Because if I don't know about anybody else, but I know I definitely don't know what's going to happen here with the COVID curve, and how long this is going to last, things of that nature. So getting to understand the possibilities is really important. So, and then the last one is just be athletic, think outside the box, because we got to be creative. This isn't an easy solve, and in my career, this is definitely the toughest time I've ever seen, and it's not even comparable to anything else. So it's been really an interesting time. So we go to the next slide. This is our approach that I'm gonna walk through the team about how you might use the COVID curve, and just kind of using our model to just illustrate these implications as we walk through here. So there'll be assumptions that we can adjust on the left that we'll adjust, and then we can kind of track some of our main metrics. So if we go to the next slide, this is the first part of the COVID curve. So when thinking about what's going on right now, one of the key concepts that we've thought about is this concept of the dip. So how much of our revenue has been lost? And every industry is slightly different. So some industries have lost 100%, some industries have lost 20%. And then different organizations have way different makeups in terms of how much of their cost of goods sold is variable, things of that nature. So you're trying to figure out how big is this dip and how long is this going to last. So, and I'll go through the whole curve here just real quick, and as you kind of are thinking about this with your own organization, you're thinking about this dip, how big and how long it'll last. Then you think, well, when do we get back to our status quo, this turn? And then we'll jump into the recapture. So that volume that was lost, do we have the capacity to do it? Do our customers still need us to do this? And then there's, at the end, it's kind of thinking about the new COVID reality of, okay, what really is going to be happening here in the future? I was on a call with a different client earlier this week, and they said 40% of my businesses are going to probably customers are going to go out of business. So their new trend line was going to be 60% of what it was when they were planning for this. So when you look at this, the key value of like trying to put your information on your own COVID curve as you're analyzing this is, as we're going to go through here, you can start sensitivity testing to say, well, what about if the dip's bigger or smaller than what I'm expecting? What about if the dip's longer or shorter than what I'm expecting? And you can start, if you could start figuring out where those key decision points need to happen, that, okay, if my revenue right now it's at 40%, but if it gets to a 60% dip, we're going to run out of cash here. So then we're going to have to pull these different triggers of furloughing our workers or giving everyone an across the board 10% payment reduction. And then, or every day, every hour, we're learning more and more things. So, and things are changing just at an exponential pace here right now. So if we start noticing that 2 weeks down the road, we now know that this COVID curve is going to go and we're going to be in lockdown until the end of June. Okay, well, that's going to change some of our assumptions. Okay, now what does that mean to me? And if you can start to articulate where those decision points are going to be for your own organization, you can know then when do I have to get an additional line of credit, or how big does my PP, or how big do my EIDL loan have to be here going forward in the future. So we're going to focus in on each one of these different steps. So the first one is the dip, and this is how big and how long. So if we go to the next slide, we can go, yeah. So what you do for the dip and how we've thought about it, and you could probably think about it the same way yourself, is what percentages their volume is at risk. So this organization said 70% of my revenue is going to be gone, and that's what I've been noticing to date, and that is going to last until the end of June. And to me, that's going to cost $1.4 million in lost revenue. So then if we go to the next slide, it kind of shows, if you're doing this internally, how you might do that yourself is you really say, okay, well, what's my monthly revenue? And this doesn't have to be a perfect science per se. If you're doing it yourself, it's saying, okay, well, our way is figuring out what our monthly revenue is and then taking away 40% of it based on the time frame that we had identified above. And so what this model is showing though is this is saying that, okay, once 6:30 happens, we're going to turn on that light switch and we're going to be back to full bore tomorrow. And you can see that straight line down at the bottom in the revenue impact curve, that odd shaped black box. So if we go to the next slide, when you're sizing this up for yourself, you might want to think, okay, well, what about this turn? This turn, when are we going to get back to our status quo, or maybe our new COVID reality? And some people have thought, and they've looked back and they've said, well, if we're going to have a V-shaped curve, that's normally a quarter, so that's 12 weeks. Or if we're going to have more of a U-shaped bounce back based off of other pandemics, that might be 24 weeks. So you can start saying that you can take that approach, or some other people are saying, well, to get everybody back in the saddle and get them operating at peak capacity, it's going to take us 2 weeks. And so you can just kind of, and everybody's unique, and you can kind of test those different sensitivities and see what they mean to you. So if we go to the next slide, this organization said, well, it's going to take me 8 weeks to ramp up to this new reality. And that timing, those 8 weeks, we're also going to lose another $575,000 worth of revenue. So if we go to the next slide, you can kind of see how you might want to do this. Is we basically straight line that revenue going forward from July to September. And now you can see, instead of going straight up at the end of June, we ramp up into our performance until we get to the end of that 8 weeks where we're at the right where we're operating at full capacity. So if we go to the next slide, the next slide to think about is the recapture. And to us, the recapture is that volume that was lost in that time frame, whether it's do our customers still need it, or is it something that, you know, the customers, they won't need it anymore and there's nothing to recapture? Or another way to look at it is our customers might need that, but we've been highly efficient and we've always been operating basically at 90% capacity, and we really can't recapture too much even though our customers need it. So we're really maxed out. So you try to think about, you know, of that lost revenue, how much can you get back? So if we go to the next slide, you can kind of see, well, if this organization thought they could get that money back, 25% of it, and they could get it back in 5 weeks. So utilizing this approach, you can say, well, how much of that am I going to get back, and how long is it going to take me to get that back? And then you can put the revenue into a time and place. So if we go to the next slide, there's a yellow bar at the bottom. this is that uptick in revenue. And if you see that green graph shooting up that 1 month, well, that's that extra revenue that and margin that we're going to end up getting that month, that we're going to recapture some of that 25%, which is going to help us with our cash flow rates. And as we kind of keep going here to the next slide, then it's really, what is this new COVID reality? And this new COVID reality really states at the 10,000 foot level is just really saying, well, what does the future look like? Are we going to go into a recession? Is it going to slow down, or are we going to be able to get back to 100% of what we look like? So if we go to the next slide, this organization really thought that, well, we are going to lose about 10% of our base, because we work with employees, and if people are going to be unemployed, that's going to lower our revenue levels. So if we go kind of the next slide, you can kind of see what does that ramp up look like. And the thing we're trying to do here at a 10,000 foot level is we're really trying to say, okay, well, now we really know what the revenue looks like, but I want to know, and we're tracking at the same time what our cash flow looks like. So we now know how big of loans we might need to take. We now know if we're going to have positive cash flow as we're rolling through here. So the next slide here is really, now, how are we going to size that gap to get to our financial performance targets that we need to make, whether they're short term or they're long term? Are we going to furlough workers? Are we going to give everyone an across the board cut? Do we have some non-labor expenses that we can get rid of? Do we have some discretionary benefits that we can get rid of? Can we make changes to our capital spending and so on? So as we kind of go through, this organization was having cash flow issues at the beginning. So if we go to the next slide, you can kind of see, well, right away they decided, well, we're going to get rid of 70% of our workforce. And they got rid of 70% of their workforce for the rest of the year because of the dip of 70%. And they went from having a cash need, whether they were going to take out a loan or something like that by the end of June, to at a high level that now at least they're going to cash flow through the year. They're going to survive through this. The next slide is, well, they were actually able to apply, and they were able to get a PPP loan. So what we use this tool to look at for them was to say, okay, well, if we're going to get 8 weeks worth of our salaries covered, how much is that worth to us? And then if we go to the next slide, we can really layer in to say, okay, well, for that time frame, we're going to save those salary expenses on a cash flow basis because the PPP loan's going to recover it. And then utilizing different aspects, you can kind of say, well, what does my cash flow look like throughout this whole process? So if we go to the last kind of slide on this, is there's just different ways to cut it, and you want to be able to track all of this in real time. But what we're trying to do is we're trying to say, on a monthly basis, do you have the cash flow to figure this out? So if you're thinking about this, the first time we ever went through this whole process with an organization is they came to us, and they were in Louisiana, and they came to us and they said, hey, we're starting to notice that our volumes have dropped off, and this was before these stay-at-home orders were happening. And they said, well, how much damage is this going to cost us? So we took the high-level approach, and we said, well, you're going to lose this much revenue for 8 weeks and 10 weeks, and that's going to be worth, let's say $10 million. Well, once you start to realize it, and if you're doing this yourself, that did not put into time and place when that revenue was going to be going out the door, because that they were lucky enough that they had plenty of cash to be able to hedge that little hiccup that we initially analyzed. But if you don't put these financial impacts into, especially to see what the impacts are on your cash flow for the next 60 to 90 days, that is almost the most important part as you kind of think through this and you're doing these types of analyses. So
Matt, I just wanted to add here too, is that I think what, in this is that it's all relative. Like, we could say 10 million, we could say 100,000, right? And so,
yep.
Where this fits into any type of zeros, what you have here. And so this is can be critically used for any type of numbers that we're talking about as far as a business.
Yeah, and to that point, Marty, that's a great point. I mean, I've put organizations in here that have had $2 billion worth of revenue. Our own firm utilized this tool to kind of help us think about how we're going to be impacted here in the future. So yeah, it's incredibly flexible in terms of size and scope. So yeah. Well, some of the key processes and next steps. And these are just processes. Is you want to evaluate what your revenue is at risk. This was really important 3 weeks ago when this was first happening, and we didn't know how much our revenue was going down. Now, I don't. Maybe you feel that you might be on bottom. I still don't know if we're at the bottom, because on a weekly basis, my clients are saying that their revenue is still going down, but at least we really know how far down we've gotten to date, and that can really help size up. And in a lot of cases, it's looking at what revenue's not at risk, that you'll be okay. And then you really want to memorialize these different options and highlight at what key status points in this curve, if the dip gets to X%, or if the length of the curve gets to Y, when do we have to make operating responses? And if we do have to make operating responses, what might those be? And then if we go to the next slide, it's just these are just some of the key features and benefits, but we don't have to go over those per se. But it's really just, our approach was really designed to give you actionable financial intelligence. I think the COVID curve, that applies almost to anybody, and it really is a way to really take, get some actual actionable information and organize the chaos that you're experiencing, and give you a structured process to think about how this might be impacting your organization. So yeah.
I think there's a question on the chat room where they're asking about, are lenders permitted to charge loan origination fees on these loans? Now, I don't know for loan experts, Matt or Leslie. I know here in the state of Florida that our governor waived doc stamps on these loans. I do know that there has been some talk as far as fees being added on these loans, but I'm not sure. Do any of you know that answer for sure?
I do not.
Yeah, but we can find that answer. I don't know who asked that. We can go ahead and find it. We have a whole team of probably about 25 people, CPAs, that have raised their hands internally within our office to say that they'll be subject matter experts on all of these loans. And so we're taking these questions from the chat room, and we're more than happy to get you that answer.
Great. So thank you, Marnie, Leslie, and Matt. In closing, if you are a manufacturer that has been impacted by COVID-19, you can reach out to your respective Florida Makes business advisor. Again, this will be sent out after the conclusion of the webinar, so you'll be able to go back and reference this if you need to. If you are a second stage business, you can reach out to me directly with any questions. However, if you do have any concerns specifically related to COVID-19, I encourage you to use our Expert Connect feature on our website. This just allows us to process your questions in the most timely and effective way possible. So we do understand that the importance of getting correct information to you as soon as possible. So we'll work immediately on getting those calls set up once you submit your form. And then unfortunately, we have hit the top of the hour, so we don't have any time left for questions, but there is Florida Makes contact information if there is anything they can assist you with, and our presenter's contact information was in the slide deck as well. So thank you to our presenters and all of you for joining us this afternoon. Lastly, the next Florida Makes webinar is next Thursday, the 16th, and it'll be covering employer risk when dealing with COVID-19. We do ask when you exit the webinar, if you could please complete the survey that will follow. This will help us improve these webinars and better meet your needs with topics of value to you. So I hope you all have a great rest of your day and stay safe.